I'm going to start this week with a couple of companies that reported earnings. We'll start with Taiwan Semiconductor here, and then we'll look at Freeport. If you have the applied level in sector studies this week, I will be adding the sector for IT, and within this sector, there is an industry for semiconductors, and it is a complex industry. So I will add the video for the IT sector. Then I will add a video talking about the structure of the industry, who supplies who, because it is important to understand. When we looked at Taiwan Semiconductor, we got to this screen. There is one company right away we should have said, I'm buying that. Here is third quarter 2023 revenue by technology. 5 nanometer, and I look over here, 3 nanometer, and it gives you sort of the growth in this over time. If we look back at Q1 2021, dominated with the 7 nanometer and 5 nanometer showing up. Look over here, look at the size of 5, and 3 is starting to show up. This is important because there is really only one company that supplies the equipment for this. So Taiwan Semiconductor, TSMC, is a fabrication facility, and it has equipment suppliers and it has material suppliers, and its equipment suppliers help it produce this type of output. Especially when you get into 3 nanometers, there is one company that dominates, which is ASML. With EUV lithography. That's extreme ultraviolet lithography, getting down to 3 nanometers. They basically have a monopoly on this. So when you see something like this showing up and you see 5 dominating and 7 sort of disappearing, then you think, well, who is supplying this? There's only one company that's supplying this. It's ASML. These machines cost about $200 million each, and they come with service contracts, multi-year service contracts, which is another source of revenue. So ASML revenues on the machine itself, and then the ongoing service contract. Canon recently announced, just in the last couple of weeks, an introduction for the 5 nanometer technology. A lithography machine for the 5 nanometer technology with potential for 3 and maybe even 2 nanometers. But again, look at the cost and the idea of the service contract. These are very sticky suppliers that if you already have a relationship with ASML, you're not going anywhere. And there are really 2 big fabs in the world, TSMC and Samsung. You can say Intel as well. Intel doesn't make for anybody else, only itself, but it does have fabrication facilities. But the 2 big guys out there, TSMC and Samsung, ASML has them wrapped. And if the 3 is going to, the 5 basically is going to replace the 7. In time, the 3 is going to replace the 5. Who's going to be the winner in the long term on this one? So again, if you have the applied level, there'll be a video up this week breaking down the semiconductor value chain. And once that's broken down, if you had looked at this chart after the fact, you would have said, oh, that is really bullish for ASML. Okay, next we have Freeport. Reported earnings and had a good price bump off of earnings. They did quite well. And then during the rest of the week, copper prices slid, and Freeport slid as well. Quite a lot on Friday. I think some of that may have been due to some thinking about Tesla's results. On the conference call, they did mention that based on this statement, they made this statement early. This is from slide 4. The presentation deck was 12 slides. This was slide 4 of 12. Rising interest rates, US dollar strength, global geopolitical and macroeconomic uncertainty is impacting sentiment. And they note that you have a price decrease over the quarter and inventory builds over the quarter. And this sentiment was echoed quite a few times in the Q&A. Current prices don't support significant capex at this time. So the focus of a lot of their CapEx is on incremental improvements to existing sites, sort of brownfield CapEx as opposed to greenfield CapEx. Exchange inventories remain at historically low levels despite the recent build. Here's the build in inventories corresponding with the drop in price. And you can't see, this is January 2022, so there's 21 months here. You can't really see how inventories have come down over time. It sort of just looks like, well, no, they were higher over previous periods. What are you saying? They remain at historically low levels. You got to think back to prior to 2022. Look at a chart that extends out a longer period of time. But the inventory, copper inventories are lower. For those who are aware of Freeport's reserve price and the resource price, the reserve price is at $3. The resource price is at $3.50, and this is what they say over the long term. So it's not as if a price dropping below $3.50, then we begin to question the size of the resources. It's if it stays below $3.50 for an extended period of time, you're going to have resource numbers that get revised downwards. And if your price drops much below 3 and hangs there, you'll have your the reserve numbers drop down significantly. Well, these are, big negatives for companies. The call had some commentary on where the price could go, and the argument is that 10 years ago a $4 to $4.50 price for copper was considered very, very robust, very nice. But with inflation over the past little while, just the cost of getting a pound of copper out of the ground has risen significantly, such that $4 to $4.50 is not what it used to be. That the price getting much below 3 would be difficult without supply almost disappearing. Growing consumption globally, led by China. Global consumption led by China is growing, and they point to wind and solar. And they say it's globally, right? They introduced the idea that they're seeing demand from India begin to increase. Now, if the next 20 years in India looks like the last 20 years in China, then that is really bullish for copper. This one here is troublesome. EV and renewable trends are copper intensive. Well, we could say EV and renewables are copper intensive. Okay, let's just take out the word trend for now. They're copper intensive, and would be or could be supportive of future demand. Renewables, I think we're in there. We're seeing a lot of this with utilities. The investment they're making in new power generation is predominantly from renewables. Well, all of that takes new infrastructure because, well, it's renewables, right? Nothing exists on the grid. When you build a solar farm, you must attach it to something. That's copper intensive. It's the EV side. We've already seen in the UK the deadline for internal combustion, new internal combustion sales be pushed from 2030 to 2035. There is growing concern among the auto companies about the speed at which they're transitioning to EV. And if everybody tried to transition to EV based on the announced plans, they were going to hit a wall of supply in 2025, 2026. That would have been it. Supply prices would have just skyrocketed because of the limitations for supply. Tesla's sales sort of brings up the idea of the early adopters to mass market transition conversation, which had some whispers a year ago and started getting louder, and now more people seem to be talking about the big risk to EV now is we're at the end of the early adopters. Where's the mass market? Ford, their new electric F-150, when it was first introduced last year, every unit was sold and they had a reserve book. So it was, well, we have years of production that are sold. Well, dealer inventories are climbing. I think it's of production, 1/3 of production is sitting in inventory right now on dealer lots. They're not moving. Tesla, quarter over quarter, year over year for the same quarter, significantly lower average selling prices, but volumes came in even below the lowered level of volume growth that was expected. Revenues missed even a lower level of revenue expectation. Earnings per share came in even below a lowered earnings per share expectation, and inventories are building. So the question that is naturally being raised is, are we, being that we're seeing inventories building, are we at the end of the early adopters and the mass market just isn't there yet? And if that's the case, then for the copper thesis, the EV story just becomes a little less exciting. Freeport reports that in North America, demand for copper from auto companies is up, from housing is down, and cables are up quite a bit. This is to support growth in data centers and renewable energy generation, which I think that's going to continue on. I think this is a trend that you can bank on. I think India is a trend. China, I have a question mark on, and EVs, I now have a question mark on, which when I think about the copper thesis going forward, yeah, I still believe that it's there, but I'm not as excited if EV is not going to make the leap from early adopter to mass market, and that just doesn't seem like the evidence is there yet. This is slide 5 from Freeport's third quarter investor presentation on their earnings call. This is really interesting. Leach innovation. If you have the applied level in the materials under sector studies, you go into materials, there is a video, Understanding Mining. I'll just shorten it to Understanding Mining. And then there's almost a 5-hour video on Freeport. So if you had gone through that, you'll understand what's going on here with leaching. The goal was, with improvements in leaching, to hit another 200 million pounds per year of copper recovery. And this is copper that was not in their reserve number. So this is just incremental copper that does not deplete the reserves. It was considered unrecoverable before. 46 million pounds in the quarter. So you're talking about 184 million pounds a year run rate, and the target was for 200. So they are at 90% of the year-end 2023 targeted annual run rate. So Q4 we would expect 50 million to hit the 200 million. What makes this exciting is this has a cost of $1 a pound. Their all-in costs for copper in North America are $2.62 a pound. $2.62. This is what's referred to as their unit net cash costs. The gross cash costs are $2.98. The net cash costs are $2.62, because in North America, when they mine for copper, they end up with some molybdenum, and they can sell that molybdenum. They weren't there for the molybdenum; it just showed up. So it is an offset to their costs. So it brings their cost down to $2.62. $2.62 to get copper. However, if you apply these leaching innovations, the incremental amount only costs $1 per pound. Isn't that beautiful? And in the medium term, they've identified opportunities, not just for the 200, but to add another 600 million pounds a year on top of the 200 million pounds a year. So if you can get your incremental cost down to $1 a pound, that is an excellent return. Productivity initiatives, both staff and asset efficiency. They're pointing to staff efficiency in the sense of saying, listen, if we had the right people in the right place, our throughputs could be a lot higher. We can see in South America, where they do have their staffing efficiency in place, Cerro Verde, third quarter 2023, the mill rate, 431,000 tons per day, a quarterly record. So you spend money and you build a mine, and there's your tunnel underground, and you bring up ore. You are more efficient per dollar of invested capital the higher your throughput rate. Look at that, quarterly record. and Grasberg 207,000 tons per day. A new crusher to support increased mining rates in the GBC, the Grasberg region. This is what you want to see. You want to see that for the invested capital you have, that you are increasing your output rates. So South America, Indonesia, North America, all doing well. This is why I like Freeport. I think that copper has a good support based on what is being built out and the costs to get it out of the ground. They do have a point in their presentation that at these lower prices, it is going to hinder, not just for them, but for a lot of other copper companies, is going to hinder investments in greenfield sites. Well, if you have that and you fast forward 2-3 years, what happens when you have a lack of investment? It creates a lack of future supply. So I think based on their results were good for the quarter. However, the weight of copper prices into the end of the week and some reflective thinking on Tesla's numbers and what that means for, and I'll draw that curve out like this, and we will draw the chasm in here. That is called the chasm, if you're familiar with the book Crossing the Chasm. There's your early adopters, there's your mass market, and you got to get from early adopters to mass market. You got to cross this chasm, and the question is, are we at the end, the peak here of the early adopters, and we're not ready for mass market? If that's the case, then this extra demand for copper for EVs might be 3, 4, 5 more years into the future, and not just a matter of 2 more years into the future. Let's have a look at rates. Look at these moves on the long end of the curve, the 7 all the way up to the 30. That is huge volatility. I can't even tell you. 31 basis points week over week, how big a move that is in the long end of the curve. This has been a year of low probability events being the norm. You had a market rally that sort of defied everything that we've seen, and high rates. Very rare to have that happen, but that's what we had for the beginning part of the year. Then you had a bear steepener at elevated rates, which is rare. Now we're facing the prospect of an extremely rare event, which is a curve uninverting from a very long inversion due to a bear steepener. Usually they uninvert due to bull steepeners, not bear steepeners. Low probability events seem to be the norm this year, which is why it's been such a difficult year for macro, because if you're playing the odds and saying, well, based on past probabilities, this is usually what we expect to see, it has almost consistently not worked out that way, that the low probability event seems to be the one that's winning. That is huge volatility. Look at these moves, 30 basis points, 30 basis points, 31 on a 10, a 20, a 30. Money market rates quite well behaved. We have a curve that, look, throughout the week, all of them increased their steepness. You have upward slope from the 5 to the 10, the 2 to the 20, the 10 to the 30. And we are threatening to be flat on the 2 to the 10, the capital market inversion, which got as deep as, I think, 90, almost 100 basis points. Now only negative 14. This curve steepened by 27 basis points, 466 days. We're more than likely this week going to see a positive print on this because you now have momentum on yields to the upside over here. That it wouldn't be surprising to see them go higher, to see the 10-year maybe even go 5.10, 5.20. It wouldn't be surprising. I'm not saying that'll happen. I'm just saying it wouldn't be surprising given the momentum. Canada is still in a bad shape, negative 71, and still over 100 basis points inversion on the 3-month of the 10-year. There's still 65 in the U.S. That's the one that matters more. Not so much the capital inversion, but the money market to capital market inversion is the one that matters. Money market funds, really interesting. Decreased by almost 100 billion. Money coming out of money market funds, 100 billion. Not retail though. Retail up by almost 10 billion, both in government and in prime. Institutional down 108 billion. Prime was up, government down. Government money market funds down. And I'm going to say that a lot of this probably went to the long end of the curve, because when you're looking at the possibility of even looking at the zero coupons, even looking at the strips, some strips were paying 5.3, 5.4% for 20 to 25 years. 5.3, 5.4, that's generational. That is a lot of funds that can look at that saying, we can lock that in right now. That's it, done deal. It's hard to resist that, especially for a lot of insurance companies and pension funds. A lot of pension funds looking at those yields saying, listen, here we go, let's grab these. So I think that a lot of this money here probably just went into the longer end of the curve. I almost missed this. Balance sheet runoff continues. 15.6 billion down to 7.283 trillion. I don't know if we'll see a six handle. It'll be tight by the end of the year, but a six handle is coming up. Fed balance sheet dropped by almost 19 billion, being that the SOMA ran off 15.6, another net $3.3 billion reduction on top of the negative 15.6 billion. So you have this buyer, because this would have been rolled over. In the absence of runoff, all this would have been rolled over. That means you would have had incremental buyer at this end. So you have one thing, a buyer that's missing. You have China, which appears to be reducing its treasury holdings, not increasing. So you have another buyer that's missing as well. And I'm going to show you again the relationship between energy prices, the US dollar, and bond prices. You have countries that have to import their energy and they have to import it in US dollars, and if they don't have the reserves to get that done, if they don't have US dollar reserves in cash, they're going to have to sell the US dollar reserves that are in treasuries to get that done, because they got to pay for it in US dollars. And if you're a country that doesn't have any treasuries, you're going to have to sell your own currency to buy US dollars. US dollar is up, tells me demand for the US dollar is up. Energy prices are up, and yields, treasury yields are down. And I'll show you a chart where it'll show how at one point in time they all just diverged. Okay, November 1st, FOMC, 10 days away. And Powell spoke last week at the New York Economic Club and in the Q&A session later. David Weston from Bloomberg had asked him about the long end of the curve. Rates are rising. Is this doing the Fed's work? Are you guys done? And he sort of suggested that, yeah, it's helping. Probably no reason to go in November, but he wouldn't say we're done. He wouldn't say we're done. So look what happened here. November, 99.9%. Call it 100%. 0.1 on actually 25 basis points lower, being that this has been a year of low probability events happening. I was going to say this is just noise, let's forget it, but it's a low probability event, and that's what's happened this year is low probability events. I don't know, maybe you got to cut at 25 basis points, but it's basically in the books here as far as the odds makers are concerned, 100%. Going out to December, again, you can probably ignore that, 80-20 roughly. 80% nothing, 20% on one hike, and that would have to come at the December meeting. There's no room for that in November. Bank of Canada rate decision in 3 days. I got to put a 0% on that. I think the Bank of Canada is done. I think they're probably going to be the first to cut before the U.S. Central Bank does, because the Canadian household is far more interest rate sensitive, and from a debt perspective in a far more precarious position. So that has to be balanced. Let's have a look at Canadian inflation data over the last week. Here it is here. Canadian, the core inflation rate, negative that's core. That's not headline now. That's not just food and energy coming down. That's core. Deflation. We're looking at deflation in the core. In the last couple of months, the Canadian housing market has just been dropping off. My house gets listed Tuesday night gets listed. The agent was here on Friday to sign. We came up with a price that sort of reflected where other houses sold and the incremental things that mine has. And she said, well, let's see if we get lucky on this one. I didn't like that. It's like, lucky? We got to rely on luck? The market's not there? So I had a listing of about 15 places that sold in and around my area. If you go back to April, May, June, July, they were all selling for list. September, they were all selling below list, anywhere from 150 to 300,000 below list, and that's where we are. So that was a fast fall off just in the last couple of months. Well, I'll keep you updated as far as what happens with mine, but we'll see. Core inflation rate 2.8% versus 3.3. Look at that big step down, 2.8 inflation rate year over year. For September, 3.8. This is the core now, 2.8. Inflation 3.8 versus 4. A lot of that is energy. And in Canada, food prices. My God. Inflation rate month over month, negative 0.1. That's the headline. So core and headline both down. With these numbers, especially this big step down in the core from 3.3 down to 2.8. I got to say, Bank of Canada is probably on hold and probably first to cut before the U.S. Central Bank will cut. 4 days, we get our first look at U.S. GDP for the third quarter, the advanced number. On this one, we will get GDP, but we will not get GDI. GDI is gross national income. We get that in the second look because it takes longer to get that data. This is faster moving data. And if we saw the GDP now, little brain fart there. GDP now, I think, had it at 5.4%. The expectation is 4 to 4.5% for third quarter. PCE in 5 days. This is the Fed's preferred measure of inflation, not CPI. CPI will take these things and say, okay, what was the price increase month over month? Well, what if nobody bought this? What if people moved away from this and moved into this? So PCE will take these things that people bought and say, okay, what is the price increase on these things month over month? So CPI is a fixed basket. PCE is what people actually buy, and it looks at the price. And then there are some things that are different between the two, but this is the better measure because it measures what people are actually experiencing as opposed to some fixed basket of goods that changes in price. Then we get that in 5 days. And then Powell is talking again 3 days, 4:35 p.m. I don't know that there's going to be any incremental information on this one. I think this is going to be sort of setting a tone, especially in the Canadian bond market. This will really set a tone in the U.S. And in the U.S., there's two very odd camps right now. There is retail sales and GDP and employment. So, all right, retail sales, which deals with the consumer. There is employment, which is the income for the consumer. And there's GDP, which is dominated by consumption. Extremely strong. On the other side, you have leading indicators, again, pointing down. You have delinquencies on credit card debt and on car loans, and I'll show you those shortly. Not good. You have credit, banks tightening credit across the board. None of these things are good. So you do have two stories that seem to be growing here. Which one is going to win? New York effective federal funds rate 5.33. Reverse repo down again, down 13 billion. It increased into Friday. It was actually lower throughout the week, with money market rates being where they are and with issuance being where it is. There's you could do better than 5.33, and there's supply. So this was expected. Lags, I figure let's just stick with the 12-month lag. as opposed to all the different lags, because they keep underlying the 12 months. So effective federal funds rate now is 5.33. 12 months ago it was 3.08. So if we think it works with a lag, all of what we're seeing is still got a 250 basis points of effect left to be felt. Real rates, all of them, except the 5-year, all of them increased. And if we're looking for restrictive policy, it is on the real rate that we gauge the direction we're going, and week over week, monetary policy definitely got more restrictive. Break-even rates, all higher. That's a curiosity. They're all higher by quite a bit. The effective federal funds rate, the federal funds futures, not a lot of changes here, bottoming out in February at 5.405. Last week it was 5, put a 5 in there, buddy, 5.41, so a drop of half a basis points. Going out to mid-year, 5.18 versus 5.19, and end of September, end of third quarter, 495 versus 4.965. From the end of February to the end of June, 22.5 basis points. From the end of the second quarter to the end of the third quarter, 23 basis points. So it looks like the Fed funds futures are saying sometime in Q2 you'll have there it is down here, sometime in Q2 you'll have a rate cut, sometime in Q3 you'll have a rate cut. And if we look at December 24 versus December 23, it's 80 basis points. If we think 50 is going to disappear, that's left, you got 30 left. We can say there's another 25 basis points in Q4. So the market, based on 1 month SOFR and based on Fed funds futures, looks like it's saying Q2, Q3, Q4, one rate cut per quarter. TLT did not have a good week. My God, it did not have a good week. Down another 5%. SPY down 2.4%. Lots of implied volatility on TLT, however, so that if you wanted to use the options, if you wanted to sell calls, 1 week calls, I think are still paying something like almost a buck if you were going to like the 84. But if you're looking at the 86 or 86.50 1 week out at a time, there's lots of premium in there. Look at the IVP here, 95% 13 week, 98% 26 week, 92% 52 week. If you are long TLT and you wanted to sell some calls for some premium, you can go to a low delta call, maybe even do a straddle, a low delta put like 10 delta or 20 delta, although I don't know that I'd do the puts right now, but you could probably generate some or at least match the dividend by selling the call. If you're going out 1 week at a time, you could probably find a good 25-30 cent option every single week on TLT. I added more 2048 bonds as TLT sold off. I think I did it right here in the morning. It was like 8:30, between 8:30 and 9, or was it between 9:30 and 10? TLT sold off in the morning, and then it rallied. It sort of hung out there for the day, but in the morning it was still selling off, and I was thinking, okay, I gotta buy more. So I bought more. I think I bought at 27.05, I think, or 27.04 on the 2048 strips, the principal strips. I was buying at 27%, 27 cents on the dollar, which is not bad. I will keep buying. I will keep putting more into bonds. And a month and a half ago, 2 months ago, I was moving money into bonds because it's the easiest way to move money across a border from one broker to another. If they're all sitting in bonds, it's nice and easy. There's no question whether or not it transfers. It does. But now I'm buying them because I think I'm getting 5.32% on that. I'm comfortable with that. I'll leave it there. I have no problem with that. And sometime in the next couple of years, you are going to get rates going down. They're going to go down, and the return on these are absolutely incredible. Okay, this is some interesting stuff here when we get to housing and mortgages. We have 7.63, another high on the 30-year mortgage. This is as of Thursday. On Mortgage News, if you went to the Mortgage News Daily site, they have a survey-based system, a method by which they get a mortgage rate. It had hit 8% earlier in the week, 8% on 30-year fixed-rate mortgage. This is 7.63 here. The U.S. Treasury increased by 35 basis points over the week over week, and here we're up 6. So the spread actually contracted 29 basis points, 265 basis points, but it didn't help the mortgage REITs. Agency and Annaly both hurting. Agency down to 820, well below its tangible book value per share. Annaly down to $16.24. IYR for REITs, that's the right move, 74.75. I don't know why it took that long to get to that point. Cap rates are still way too low. I think IYR is probably interesting somewhere in the $50 range, $55 range. It's at 74. I still think it has downside to go. PLD, DLR, both REITs selling off. Housing, very curious here. Let's just go up to the National Association of Home Builders Index. Came in at 40. I put an exclamation mark behind that because the expectation was last month was 45. Oh, it'll drop to 44. It dropped all the way to 40. I mean, sentiment among the home builders is just disappearing, and they're the ones doing it. They're the ones building these things, and look at that. Well into contraction territory. Mortgage apps down 7%. Lowest level. The mortgage market index is at the lowest level since 1995. Almost 30 years you'd have to go backwards, 28 years backwards to get to a market where the mortgage activity was this low. In the last year over year, the mortgage market index down 73.2%. It was at 623.8. It's now at 166.99 from the peak, which was December 31st, 2020, down 83%. Think about that. 83% of that market is gone. The market is 17% of the size it was. Building permits for September, negative 4.4%. Existing home sales, negative 2%. Yet, this was rather interesting. Housing starts up 7%. Doesn't quite fit with the direction of where the sentiment home builder index was going. So maybe it was just a matter of let's get these built and let's move this inventory. Maybe we got money in the lot. Let's build something on it and move it. I don't know, but up 7%. Home builders really suffered. DHI down another 3%. Lennar down another 5%. DHI is now at $100. It had peaked over $130 this year. Down at 100, and I think it still has more downside. You take the combination of these rates and this over here combined with this and all of this, I just can't see in the near term a lot of support for the home builders. In the long term, I'm bullish. I'm still bullish home builders. If I were going to go in a coma for the next 5 or 6 years, I'd be buying home builders today and saying, thank you, wake me up in 5 years. That doesn't mean in the next 6 months I could have bought it at $80 instead of spending $100 for DHI. So I think in the near term, I would be cautious on home builders, but I would see any move down would become harder and harder for me to ignore. Now, I really want to wait till the new year before I deploy money back into equities once I've switched to a new broker. But I may find it difficult to resist if these continue downwards. Pulte down 4.5%. KB Homes 3.5%. Toll Brothers 4.27%. Look at this guy. Last week I'd asked, this thing is so volatile. Does anyone know anything about it? Because I've never looked into it. And the result is that it's a small float stock. That would explain the lack of options and the high volatility. Whenever you have small float stocks, they're going to be super, super volatile. Very rewarding to play, very dangerous to play. So if you're looking for lottery tickets, you're looking at the home builds, you say, I want more risk. Well, here it is right here. It's a matter of when you grab it. Like at what downside do you grab it, being that it is small float, almost any volume into this thing is going to move the price. That means any recovery in this market, this guy is going to skyrocket. Beautiful if it had options. If it had options, it would be a great play because you could probably, with the heightened volatility, do a great risk reversal on this where you sell a put and buy a call, both of them out of the money. But with this one, you got to buy it. You got to buy it, which means you got to live with the volatility. And if you thought, well, last week it was a low enough price, well, this week you're 13.3% poor on that one. That's the risk of that one. What do we got coming up this week? Wednesday, new home sales, and Thursday, pending home sales. I guess this we would expect to fall into line with this because if new home sales are up and if housing starts are up, then this would have been up. So if housing starts are up and this is down, I would naturally expect that Wednesday new home sales can't be that great. Must show some contraction there. So how would I play this? I would be nibbling at agency over here. I don't know that I'd be going all in because it is momentum to the downside right now, and who knows where sentiment could bring these things to ridiculous levels. But I certainly wouldn't be ignoring these things. There is a story, or has been a story going around about the probability of bankruptcy on Annaly sitting somewhere at around 32%. That is model driven. I read that story. It is model driven. You can't model drive these things because it is a company with financial assets, which means it lists them at fair value. It's going to have huge fair value losses, unrealized losses that show up in earnings. So yeah, model based, it's going to look ugly. You have to do it with cash flows, not with EPS. EPS is meaningless for mortgage REITs. EPS is meaningless. You have to do it with their cash flows. So I would really not pay too much attention to that. But I'd be nibbling here, but I wouldn't be diving in. Here, I'd start to get interested, but right now, if it were me, I would have probably pulled my bids. And if I were selling puts with the heightened volatility, I'd probably be selling puts on DHI at the 90, and maybe even 85 3 months out. Because under 85, I think I would have a very hard time not buying. And I'd probably focus on just the two biggest ones and ignore the smaller ones. I think Hovnanian, just because it is this lottery ticket, if there is more downside, I'd probably want to buy some of it just because of its volatility, but I certainly wouldn't be loading up on that one. I would be cautious on both mortgage REITs and home builders right now. There is momentum on the long part of the curve. On yields going higher, I think they do. That's how it feels. It feels like it wants to go higher. We've had a big geopolitical event show up. We did have a small little rush to safety, but then it was ignored. So there would have to be a significant escalation in that region to cause concern, or another external event. And exogenous events happen all the time. They happen all the time. There would have to be something significantly exogenous or something really big endogenous that is out of the Fed's control, like an emerging market default somewhere around the world, which causes a cascading effect of fear, and money goes rushing for safety. There, U.S. Treasuries would get a bid, but it would have to be something that isn't just localized, that the Fed could introduce some liquidity and solve. It can't just be another regional bank failure. I don't think that's going to do it. It's got to be something that threatens global growth, and companies would react very quickly by paring down their staff very fast. I don't know. I don't think you're going to get that in the next couple of days. I don't think the Israeli-Palestinian Hamas conflict right now is going to go away. And even if it escalates a little, but is still maintained to those three players, then I just don't see the rush to treasuries, which means I do expect probably an uninversion of the 2 to the 10 coming. So I would not be touching home builders or mortgage REITs in any significant fashion, being that you have this momentum on yields to the upside. Okay, here is the US dollar. There's DXY. Here is USO, which is reflecting WTI, which WTI and Brent are highly correlated. And there is TLT. Look at this point in time where US dollar, energy, and TLT went straight down. Previous to that, it did look like there was some relationship, but it's kind of hard to draw out. So what I did was I took the US dollar out of it. And here is just over the last week, energy and TLT. So USO kind of just went sideways. TLT kind of went sideways. Then USO had a nice big drop, which TLT had a nice big increase. Then USO increased and TLT went right back down. Then you had a gap up on energy and you had a gap down on TLT. Then you had a massive rally in energy and you had a big sell-off in TLT. Then you had sort of a sell-off that day, but more sideways. And here you had sideways. Look at how it almost works in lockstep. So it's not just the price of energy is causing a higher yields in treasuries. There has to be some mediating variable in that, and that is the dollar. You have countries, because energy is bought and sold in US dollars, is if you have some countries, let's just say country A and country B. Country A has US treasuries, country B has nothing. For country B to continue to import its energy needs, if it's not energy sufficient, if it's importing energy, it's going to need US dollars. So it sells its own currency to buy US dollars. That does explain the rising value of the US dollar in the face of rising energy prices. Country A needs US dollars and it doesn't want to sell its own currency. It has US treasuries. It sells US treasuries to get US dollars and then it buys its oil. That is also consistent with higher energy prices and lower treasury prices. It is consistent, and this relationship just seems too clear to ignore. That if we had a crash in energy prices, you might have a sustained rally in bond yields because you would have less selling of treasuries from countries that have foreign reserves wrapped up in treasuries to get that done. And the stronger the US dollar gets, the weaker other currencies go, the more of your local currency you have to sell to buy the US dollar. You have declining currencies. Looking at the yen sitting around 150. Big part of that is the importation of its natural gas and its oil that it would need that are denominated in US dollars. It is the one story where the chart seems consistent and the relationships seem consistent. Stronger dollar, stronger energy. You got to get the money from somewhere to pay for it. You may as well sell your reserves, which are treasuries. Now, there are other things going on at the same time, but this chart just seems, these relationships just seem to be too well-fitting to that theory to simply just say, well, I don't think there's anything there. I think there's something significant here. If we expect energy prices to go higher, more and more countries are going to have to sell more of their currency to buy the US dollar, which will push the US dollar higher, maybe even have to sell their reserves to get their US dollars, which could continue this. With what's going on in the Middle East right now, if more countries start standing up saying, we got to pick sides here, this really could continue upwards, which means you could get more momentum to the downside on TLT. All right, four things here. Number one, credit card delinquencies, 11-year high. Here's where it is. You go back here. You got to go back to late 2011, 2012 to get those credit card delinquencies, and they just skyrocketed, didn't they? Now, mind you, before 2018, 2019, they were coming back. They were coming back up. The government gave everybody a lot of money. That got spent. Now they no longer have any money. They're returning back to sort of the trajectory that they were on. You could say they're even below where they would be, but still 11-year high. Number two, right in here, higher car prices and rising interest rates are hindering car owners' ability to afford their vehicle payments, as 6.1% of subprime auto borrowers are at least 60 days past due on their loans, the highest percentage in data dating back to 1994. 1994, 6.1%. Credit card delinquencies, 11-year high. Mortgage market index, the lowest it's been since 1995. High interest rates are having their effect. Banks tightening commercial and industrial loans to large firms. Anything over zero denotes tightening. Anything under zero is looser standards. And here's where we are. These were peaks. This one I think we can ignore, but these last two it tightens to a point where you choke off the very spending, because if you're not giving loans, then companies can't spend what they don't have. And here is commercial and industrial loans to small firms. You got large firms, small firms. Here you are again above this last recession here, which was the 2000 recession. This was the 2008-2009 recession. And that was the pandemic and going in a direction of tighter. This is what, some 50% up here. Where are we here? Some 50%. This peaked somewhere around close to 60%, I guess. This was 75%. This is higher than this peak over here. This was somewhere around small firms. Small firms always suffer more, right? Or are we 75%, and this is right somewhere around where the 50% mark. Forward 4-quarter operating earnings, 238.95 from IBES, International Brokers Estimate System. SP Global 236.43. Both of them down from last week, but not significantly down from last week. Closing SPX is down from last week. That gives us 17.77 times forward earnings. Technically speaking, not a good chart. The 200-day moving average for SPY is 423.32. SPY closed at 420.60 on Friday, below the 200. Draw your uptrend line. This is a 1-year uptrend line, closed below the uptrend line. There is the most recent downtrend line. So from a technical perspective, you're below the uptrend line and you're below the 200-day moving average. So you could have a retest of that 200-day. And if it fails at the 200-day, if it fails at 423.32, technically you'd be looking at the last consolidation area, which is somewhere around 4,100 to 4,000 on SPX. On SPY, 400 to 410. We're sitting at 420.60, so 100 to 200 points to the downside. Lots of volatility, lots of implied volatility. 13 weeks is at 100%. 26 week is at 100%, and the 52 week 67%, up from 47%. A recent paper from, I don't know who in the Fed released it, or in the federal system. I'm not going to point to FOMC. In the federal system, there was a paper released pointing to the long-term average forward multiple at being at 15.5. But this is data going all the way back to 1990. I think the look-back period is too far to determine that number, because there is lots of reason to think that the next 10 years are not going to look like the 1990 to 2010. There is far more revenue in the S&P that is derived digitally than there was during that period of time, and digital revenue tends to have diminishing costs to scale, which means margins just improve over time. There is more technology-based revenue in the S&P 500 than industrial-based revenue that you would have expected to see during the 1990s. And industrial-based revenue isn't that scalable, but technology-based revenue is. A greater proportion of revenues come from outside the U.S. and not really subject to U.S. The economics of a mature market. So I don't know that I would say that 15.5 is a good attractor point in terms of a long-term average if we're looking at the S&P today. But that doesn't mean that you can't get there. If you get to 15.5, I don't know that I would conclude that we are fairly valued on a long-term trend. I would say that we are probably undervalued based on the composition of the index's revenues today versus 30 years ago. I think 16.6 is probably a more appropriate attractor point to use for the near term, which would put you somewhere, 60% of 200, 120, and the 38, around 39, somewhere between 390 and 395, and we're sitting at 420. So that's still maybe 250 to 300 points on the downside. I would seem to think there would be something that is more fairly valued, but markets don't stop at fair value when they're selling off. They can get to undervalue, which means once you get much below 390, I think that's a buyer's market for sure. Right now is a dangerous place to be because you could reclaim the 200-day moving average and up you go. With the long end of the curve rising every day, I cannot see it. I can't see it. And if you don't reclaim it, then really what's your next stop? The consolidation zone that you had over here from 4,000 to 4,100. I said last week if I had to pick a direction, I don't know. This is maximum uncertainty. Only because markets have shown themselves willing to do the least probable thing. That if you look at what could happen based on empirical probabilities, in other words, looking back at the number of times a certain thing did actually happen, the least probable things have been the things that have happened. That's why I say at this point in time, I really don't know. Flip a coin. If I were sticking with the true fundamental of it all, and I were just brand new, looking at the situation, looking at the multiple, looking at where the curve is and where the curve is headed, looking at the geopolitical risk in the world, I would say I would not be a buyer of equities at this multiple. Wake me up when we get to 16 or even lower, but I would not be a buyer at this multiple if I had to look at it that way. But if I had to look at it with the behavioral effects that we've had this year, the absolute willingness to believe from a vast part of the market, I don't know. Once you bring humans into the equation, they mess up all the math. Okay, we'll use S&P Global here for the earnings. They were wrong the last 2 weeks. Well, not completely wrong, but they weren't precise. But neither was Refinitiv. And I'm looking at the two this week, and Refinitiv says you have 100 and some companies reporting, and S&P saying no, it's actually 12 companies less than that. So I don't know which one is right, and I'm not about to fact check 160 different companies. So there, I'll leave it to you. I've itemized this in terms of the sector. As opposed to the day of the week, because maybe there's certain sectors that you like and you'd rather just go to the specific sectors, or you're more interested in where's the risk in the market. Communication services, you don't have much. Consumer discretionary, you've got some here. Staples, small amount from energy. Financials, still huge. Healthcare, quite a bit. And industrials are really showing up. There's IT, not really big this week, but next week. Materials, real estate, and some utilities down here. Meta on Wednesday in communication services. There is General Motors on Tuesday. Tuesday morning. ATC is after the close. So Tuesday morning we have General Motors and we have Pulte. That'll be interesting. We'll start to get some views from the home builders on guidance. We have Pulte. And then there's Ford on Thursday, GM and Ford this week. they'll be interesting in terms of what's going on with this strike. Ford's already, made a whole bunch of public announcements about this. GM looks like they're getting close to settling off something. I'm going to be listening. I want to hear what their guidance is going to be. If they have no resolution with the union, they're going to be very guarded. They're going to be very guarded with that until they get some resolution. So, and then you can go down this list, and depending on what your, what sector you're interested in. I think in real estate, digital DLR is reporting this week. There it is, DLR. That'll give us some look into, based on its guidance, into data centers, which gives us some idea about the AI hype, whether it's still there or whether it's sort of disappearing. And I will leave that to you to go through.